All right, guys. So in this video, we're going to be actually looking at what tools you use for trading. Um, yeah, let's get into it. This is going to be a longer video, but it's very important. All right. So basically, in this video, we're going to talk about like phantom wallets, understanding DEXs, using Trojan or trading bots on Telegram, and also doing chart analysis. So we're going to talk about long-term storage. Okay. So long-term storage, you always want to make sure you're using a wallet that you own the private keys. This is called self-custody wallets. For Solana, Phantom is the wallet that I use, but you can also use Soulflare, and I think there's a couple others. Um, the main thing is if it gives you the private keys, then you should use that wallet. Um, so private keys, they usually look like this. It's just a set of like 12 to 24 random words, and then you make a password. Like I said, always write these things down on physical paper. Don't keep them digital. Don't screenshot them. Make sure you write down on paper. Make sure you write down the correct spelling. Make sure you have several copies, because if you lose this, you cannot access your money. Okay, so this is the number one thing you can do. So any long-term storage, long-term investments that you plan to hold for like a while that you want to keep safe, they will go into your Phantom wallet. Okay. If you want to add an additional level of security to that, you can buy something like a Ledger wallet or like a Trezor. I would recommend it if you're holding like more than more than $5,000 worth of crypto. This device is like 150 bucks. So I think after $2,000, it becomes worth the investment. But it's up to you. Some people never do it. They have millions of dollars. They always keep it on their, web wallet, which is super risky, but that's how some people like to do it. The only thing is, if you keep all of your money on Ledger, just be aware that it's going to be slower to do trades, because you're going to have to pull out the device, click the buttons, and then do the trade. So if you're doing any long term stuff, just send it over to the Ledger, and then keep your fast transactional trading wallet on your computer. All right, so let's get into DEXs. So a DEX stands for a decentralized exchange, which means that there's no centralized corporation or entity or company controlling the funds or the liquidity of the project. So the opposite of a DEX would be a SEX, centralized exchange. So you can think of Binance, like Coinbase, Kraken. All of these companies are corporations. They require your driver's license, your ID, all your government stuff, so that you can make an account. And in exchange, you get access to multiple coins that you wouldn't have unless you bridge to multiple chains. So it is more convenient, but the trade-off is that you are not in control of your money. You are leaving it into the custody of a company. And if you ever have problems, like you accidentally sent it to the wrong address or you accidentally sent it to the wrong chain, you have to contact customer service. You have to wait for customer service. And if you haven't done that before, it's a lot of fun. Just kidding. So in general, don't leave too much money on a centralized exchange. I use it to get on into crypto, like to turn my Canadian dollars into crypto dollars. I use a centralized exchange. And then to get crypto dollars back into Canadian dollars, you also have to do it through a centralized exchange. So the centralized exchange is like your bridge to real money from crypto. And then if you want to do any trading stuff, you can use a centralized exchange. But just keep in mind, you have the risk of they could ban you, they could get hacked. The centralized exchange could get restricted from your country, which has happened before, especially in the U.S. So it's always best to just do it on a DEX where you control the wallet, and that's what we're going to get into here. So a common DEX is Jupiter. So let me open up Jupiter here. So this is what the interface looks like. And whenever you want to do a trade, basically you would connect your Phantom wallet. So you should have it here as an extension already. Okay. And then you would just, go from Solana into whatever token, right? Like this coin, whatever, put in 0.5, hit the swap, and then it's just going to confirm on your wallet. And that's all it takes. And for tokens that are not listed on Jupiter DEX, like for newer kind of shitcoin tokens, you would find the contract address from DEX Screener or from like a tweet, whatever. and you would just paste it in here. So you want to make sure this is set to all, and then you paste in the address, and then your token will pop up there that you're trying to buy. So that's basically how you copy and paste contract addresses. Same thing with Radium. I would not recommend using Radium because it's just slow and sucks. Always go with Jupiter. And like I said, always bookmark these exchanges so you're not clicking on like fake links. Next is a really cool feature called dollar cost averaging. So this is the technique where when you want to buy into a token, but the price is going up and down a lot. So, just like this past weekend where Bitcoin dropped a lot, I was DCAing into the WIF token, right? Because I wanted to buy into the dip. I didn't want to buy it all in one chunk, but I wanted to spread it out because I knew that WIF was going to keep going up and down, up and down. So by doing a DCA buy, you are spreading the risk across a set period of time. And you are also making sure you're not buying the exact top, you're not buying the exact bottom, you're somewhere in the middle, right? Because you're averaging into it. So this is an example here, right? So I said let's say I put an order for 100 Solana. I want to buy WIF token every 40 minutes, spread over 200 orders. So that would mean I would be buying 0.5 Solana of WIF token every 40 minutes. And if I set it today, the order would be filled and completed by the 24th of April. And then you can see once the order is running, it's going to be buying, 0.33, this timestamp, and I got 17 tokens, 0.33, 40 minutes before, and I got 18 tokens. So the price kept changing, and therefore the amount I got also changed. So you can DCA into tokens, and you can also DCA out of tokens. When you're taking profits, DCAing is something you want to do if you think it's time to get out. Or sometimes you just want to sell it all at once, but there's a risk of slippage, which I'll explain here as well. So what is slippage? So slippage is, in crypto trading, it's like the difference between when you're in line waiting to buy something, like gas, for example, is kind of like this. Like the price of gas changes every day or something, every few days. But if it changed every few minutes, by the time you're waiting in line and by the time you get to fill up the gas, the time you waited, that 10 minutes, the price might have changed like 10 cents. It might have gone up. So slippage is basically, so if you set a higher slippage, it means there's going to be a bigger difference, a bigger variance between the price you buy at and what the token is actually trading at. So you want to set a high slippage when you're trading pairs with very low liquidity. So like a shitcoin that's like, under 100,000 market cap, you're going to need a really high slippage to buy into it. And for that reason, you want to spread out your orders. If you're buying a lot of a shitcoin, you want to spread it out over the orders. You don't want to do it all at once because then you'll just make the green candle go super high and then really fast, and then everyone's going to dump at that point.